Hey everybody, this is Brant from Wolf on Wall Street Trade with a market update for the week ending June 21st, 2019, FOMC week. That was the biggest event of the week, and next week it will be the G20 over the US-China trade war and tariffs. So the S&P made a new record high this week. Everybody celebrate. It is exactly 0.16% above April's record high over here. And if you go back a little bit further to the late January 2018 high, the S&P has added a whopping 2.7% over the last 17 months. Here's a quick view of the week from, let's say, a 15-minute chart. Hope all this makes sense. This is basically the end of that May decline, May sell-off. Small caps leading here. So Jerome Powell actually really was part of the big reason that the market moved so much off this low, along with CTAs going max long, but we'll look at this in a second. So a really strong week there, and then last week you might remember I had something like a symmetrical triangle here. I just opened that up more because I didn't see any reason to keep it, and I left this basically sideways range. So if we zoom in a little bit, I'll go to a 5-minute chart. So here's the week. Nothing happened on Monday. This is drag high before the open. Okay, so the market got real excited that another central bank was going to ease or turn more dovish. And this was also the morning, about 9 minutes after the open. President Trump came out and said that he had talked to President Xi, and for the first time they agreed to meet at the G20 next Thursday and Friday. So the market got excited about that. Trade war optimism didn't do anything into the FOMC, just went dead quiet. And this is the knee-jerk reaction. It really wasn't that much. I think a third of a percent. And closed kind of weak. And I'll talk a little bit more about this too. This was all these central banks overnight following in the Fed's footsteps, turning towards more easing, and the market loved that. Open up big. And then from a 1% gain on the open, just erased all of it in the first couple hours of trading. Matter of fact, if we look at IWM, it actually went from this big gain, like 1%, into the red by about noon, and really didn't recover much. Here's Friday, and if we look at the S&P 500 again, keep an eye on that 2950 level. I'll go in a little closer with a 1 minute. So here's Friday, and here's that 2950 level. It just basically moved a little bit and above and below that 2950 quad witching options expiration price pin. So first, let's talk about the Fed, the FOMC. That was the biggest event of the week. And what I want to point out is the market had really priced in a lot of easing expectation from the Fed. Not quite a rate cut on the Fed meeting here June 9th, but a lot more expectation that Powell was going to be very dovish. So I want to point out this one thing. Remember June 4th. So here's the trade war expanding and that kind of market decline through May. This is June 4th where the S&P was up more than 2%. This is the day that Powell said, "We're closely monitoring the implications of these developments," which means the trade war implications, "for the U.S. economic outlook, and as always, we will act as appropriate to sustain the expansion." So if you look at the actual policy statement from the FOMC on June 19th, basically the same thing. The committee will closely monitor the implications of incoming information, basically the trade war again, and the economic outlook, and will act as appropriate to sustain the expansion. The exact same thing he said on June 4th. So the market already priced that in on June 4th, a big 2.15% move for the S&P. Quite frankly, I was really surprised that the market didn't show more disappointment, because basically all the FOMC did, or the Fed did, was align with what Powell had already said on June 4th. As I just pointed out on the intraday charts, this is the SP 5-minute. Here's the knee-jerk reaction right at 2 p.m. to Powell. It really was nothing. It barely, this whole morning until the FOMC was dead. I mean, there was nothing going on. So it didn't even make a new high on the day on this knee-jerk reaction. This was all the other global banks easing, and that's why the market moved. So I'm not quite sure, I'm not quite sold on the idea that the market really is not going to be disappointed with this, but we're going into the G20 next week, and that's going to be the focus. Here's a chart of September Euro-dollar futures, okay, September 2019. This is the FOMC reaction right at 2 p.m. on Wednesday. Huge spike, And look where it is at 98.02. So basically what this is telling you, euro dollar futures, which are very tightly correlated with the Fed funds rate, are basically saying by September, this market expects the Fed funds rate to be down to 2.0%. Okay, so it's at 98, it's discounting 2% by September. Rate probabilities absolutely surged across the board. The market went ahead and priced in 100% probability that the FOMC or the Fed would cut rates by at least 25 basis points at the July 31 meeting as of the FOMC on Wednesday. Understand that these move and these change every day, but right now, 100%. For the September meeting, 2009, the FOMC, they have gone ahead and priced in 100% chance of a cut, but what they are reflecting is about a 21% chance of a 25 basis point cut, or the Fed funds rate being down to 2.0 to 2.25%. That could happen in July to get there, and about a 78.5% probability that the Fed will cut rates at least once in July and at least once in September, bringing the Fed funds rate down 50 basis points. 100% probability there. Danielle DiMartino is a former Federal Reserve insider. She was the advisor to Dallas Fed President Kaplan, and she's the author of the book Fed Up. I really agreed, and I really think she summarized the reaction the market is having. Basically what I said a couple weeks ago, that bad news is good news. And this is what she pointed out. This is just a retweet, and this was an interview that she did on Bloomberg. We are seeing is a celebration of the fact that we are headed into recession, such as the Fed can come to the rescue with rate cuts. Thus my comments over here in response to Danielle. S&P 500 made a new record high. Small caps have not made a new high. If you look at the biggest market in the world, the NYSE, no new highs. In fact, it has made a lower high over here. So point is, I don't give a lot of credibility to a 0.2% new high in the S&P. If you remember last week, market was going sideways, 3C was going sideways. This week, I was very, very surprised, especially on the gains on Tuesday. Not so much here on the FOMC on Wednesday. It really was not a very big move. No confirmation. So normally what I would expect is to see 3C moving with price. This is a big divergence. Okay, it didn't even make a higher high here. The Dow is starting to move in the same direction. It had been confirming and started to go divergent. It's not leading negative, but it is divergent. And QQQ, which had looked better over the previous week or so because it did have a positive divergence, but it went nowhere because the rest of the market was going nowhere before the FOMC. So this week it did come down more too. So now we have three major averages, all negatively divergent. Small caps are still confirming, so if they turn as well, this could be a really big problem in the short term. Before we get to my final point, what is this market actually doing in terms of a much broader perspective? I want to show you one other thing. So S&P, new high. But let's take a look at the sectors that have been making new highs. So those are the three most defensive sectors, or what you might call bond proxies. They act like bonds. Here is consumer staples, made a new high well before the S&P. Here is utilities. Look at what it has been doing, making new highs all of 2019. And here is real estate. What has it been doing? Making new highs most of 2019, well before the S&P. But the point I want to get to is market leadership. So if we look at the former market leaders, those are the mega cap FANG stocks. What have they been doing? So here's Facebook. Let me zoom out a little bit. Has it made a new high? No. So here is Apple. No new high. Here's Amazon. No new high. And Google. No new high. And the point I'm getting at is the change in market leadership. Here is an insightful quote from William O'Neill. I think this might have been in the book New Market Wizards or Market Wizards. If stocks that have been leading the bull market start breaking down, that is a major sign the market has topped or is topping. And this is the point I want to get to, because I think what is going on here is we have a primary bull market trend from 2009. Okay, it's been supported a lot by the Federal Reserve, and I'll show you that in a minute. We have a massive broadening top that has really been in effect since the start of 2018. So when you see a long trend like this, it's 10 years or so, you don't get a small teeny top like this. You get a top that is commensurate in size to the advance. So let's take a closer look. Now for members, subscribers, I have posted links to the May 6th daily wrap, in which I talked extensively about broadening tops. We first saw a small one here in April in all of the major averages, and that's how I got talking about this larger one that I see unfolding. And I showed you how they basically all have the same components, about 5 pivots between these two trend lines. So here's 1, here's 2, here's 3, here's 4, and here's 5. And what I pointed out at the time, this was before the market had even really sold off, was that this 5th pivot, more often than not, does not make it to this upper trend line. That is a sign of weakness. And the other thing was that this 5th pivot's high tends to be retested. So here are some charts from that May 6th post. This is specifically what I was talking about in April, were these small broadening tops on 30-minute charts. And remember, the market turned over right here into May. And then I got to discussing the bigger picture, what I just showed you on daily chart. Here's your 5 pivots, 1, 2, 3, 4, and 5. Now this was, as of that day, May 6th, this is a hypothetical scenario I drew in to exemplify how this 5th pivot was often retested. So this was before the May decline even really got started, and most certainly before this new high. That's what I drew on May 6th. That's almost exactly what we have, and that is a very common thing to see with broadening tops. Any good price pattern isn't just something you should memorize, like, oh, this is a megaphone top. You should understand what it is reflecting, because that is more important. So what broadening tops reflect is a lack of intelligent sponsorship. They are markets that are out of control, and as has been defined almost 5-6 decades ago, they are situations where the public is excitedly committed and being whipped around by wild rumors. Does that sound familiar? So I actually think this broadening top has a lot of credibility. I really would like to get in it somewhere around here. I don't see the market signal for the entry quite yet, like we did here in September of 2018, or even here in April of 2019, but we're getting close. As long as it doesn't move above this upper trend line by more than 3%. Really, the closer we can get to this trend line, the better the risk-reward outlook for the trade looks. It's really a position, not so much a trade. So that's all I'm looking for, really, is market signal saying, here's my strategic trade, and here is my tactical entry. I'm waiting for that tactical entry signal. Now, the market bulls have a different hope, and that is that the Fed will cut rates and the markets will avoid going into a recession, or the economy will avoid going into a recession. So that would be a scenario like this in like summer of 1994 into like March of 1995. The Fed cut rates. It wasn't a full rate cut cycle, and the market and the economy accelerated higher. Way different situation back then. Internet was in its infancy as far as what could be done with it. There was absolutely no signals from the bond market or anywhere else that the economy was really rolling over or getting into trouble like we see now. We don't see any yield curve inversions. And then they did it again in 1998. So let's just walk forward real quick. And you can see why the bulls are hopeful for this kind of scenario. And let me zoom in a little bit closer so we can look at 1998. And here is where the Fed cut rates again to rescue the market. Okay, again, it wasn't as bad of a situation as we have now with the types of yield curve inversions and all that. But this ultimately went up to 2000 highs up here, and then the market rolled over. So we have seen a lot of Federal Reserve support of the market, and that's why over the last 10 years, that's why I said what I said earlier in the tweet to Danielle DiMartino. Over the last 10 years, most traders and most investors don't know anything other than the Fed bailing out the market. In fact, I think on Wall Street, less than 30% of traders have seen a recession or a full rate cut cycle. So they don't know anything else. This is what they're used to. Here is the 2007 top in the S&P. Here is the great financial crisis, where not only was the entire previous bull market retraced, but then some. So that's the financial crisis. And then the Fed had really started cutting rates back in here and expanded balance sheets. So they took their balance sheet from something like 800 billion to something like 4.5 trillion from 2009. That's money that eventually goes into the market. Actually, let me just go to a 3-day chart so we can get through it quicker. All of this recovery was the Fed nonstop bailing out the market. Okay, and over here in 2015, it wasn't just the Fed, it was a bunch of central banks bailing out the market. We go higher in 2017, and here we are in this broadening top. Now, let me show you the stimulus. So here's that 2009 low after the financial crisis. So this is the Fed's first QE. They already dropped rates to zero. They kept them at zero all the way to here, about 7 years. This is the Fed pumping billions and trillions of dollars into the financial system. QE1, quantitative easing 1. When it stopped, the market started to turn down. So what did they do? They started QE2. When that stopped, the market started to turn down. So what did they do? Operation Twist. When Operation Twist ran out, they did QE3. Unlike these two, which they said we're going to buy this many MBS or treasuries, this one they said it's open-ended. Okay, we'll buy as much as we need to. Market turned over again. This time it was a global QE from the global central banks, the Bank of Japan, the Bank of England, the SNB, the ECB, and the PBOC. That's the People's Bank of China. This was their biggest stimulus ever in their history, the PBOC. So this is what anybody who really started trading in the last 10 years is used to. The Federal Reserve bailing out the market anytime it turns over, which is what we're kind of seeing now. But the difference is, here is the 3-month, 10-year yield spread. Okay, so these are recessions in gray over here, and here's the spread. These yellow areas are inversion of the yield curve. So what you see is when the Fed did those emergency, or let's call them not emergency, but insurance rate cuts to sustain the market's advance, yield curves hadn't inverted. There was no problem there as far as what the bond market was discounting. It wasn't here until we got into 2000 that yield curves inverted and recession followed over here, just like here and just like here at the financial crisis. And that is the main difference that we have not seen since the financial crisis. We have not seen yield curves invert until recently, mostly this year. The yield curve inversion is the warning. This sharp steepening is the signal right before the recession. That's the Fed cutting interest rates. Hopefully you can see this, the Fed funds rate. Once the Fed starts a rate hike cycle and then they pause like they did here, the next move is almost always a rate cut. And in both of these cases, in 2001, 2008, recession followed 3 months after the first Fed rate cut. And that is one of many reasons I think this broadening top is very valid. So wrapping it up, a lot of uncertainty into the Fed this week. We had the ECB front-running the Fed. We had FOMC knee-jerk reaction, not that impressive, until global central banks also followed in the Fed's footsteps. So I am really not convinced, especially from this, that the market is not overall disappointed with what the Fed did. Did the Fed meet market expectations? The initial reaction seems to say yes, but these are pretty weak, and you always see a Fed knee-jerk reaction on the policy statement, and then 2-3 days later, the market settles into what it really thinks. I think the most important thing next week is the G20 on Thursday and Friday, and I anticipate we're going to hear all kinds of rumors before then about optimistic negotiations and this and that, and they might make a deal, and the market has loved that kind of stuff. So I anticipate that, but Thursday, Friday is where the rubber meets the road. In the meantime, I think the market still looks pretty good in here. I'm not seeing the kind of signals that we saw in like September of 2018 or even April of 2019, but we will keep watching for them. They can show up fast. We do have something going on in volatility. Small caps really did not do that much this week. There's the consolidation range. Here's the FOMC knee-jerk reaction, and you see this little trend here. So still bullish, but not all that impressive considering. Gold had an amazing week, and this has been one of my favorite assets. Let's see, we got the 60-minute. Basically, this huge consolidation has been very bullish. All these consolidations were bullish. This was the first leg up, consolidation between. This was my second leg up, so my target is still around 133, basically breaking out of long-term resistance, a long-term consolidation. And on a 2-day chart, for gold anyway, GLD, it would look something like this. So this is a really long consolidation from about 2014. Here's that first leg, second leg I just showed you. So let's zoom in on a 1-day chart. Very, very bullish. Comes right up to this and really effectively breaks out. So my opinion is that, 133, somewhere in that area. Oh, sorry, having a little trouble there. And then prices come somewhere in here, consolidate around here, and build up some more energy. Maybe we'll see something like another flag or a pennant or a wedge, something like that. So I think this is a really fantastic opportunity in gold, an amazing week, one of the best looking assets in my opinion. So this video is very long. Sorry about that. I'm going to leave it off there. Have a great weekend, everybody.